cutting its benchmark interest rate by a big half percentage point yesterday, the fifth consecutive rate cut since June, and the second oversized move in a row. The Swiss cutting their benchmark rate as well, as I said, by a big 50 basis points. What can we expect from the Fed next week? Let's bring in Colin Cieszynski, Chief Market Strategist at SIA Wealth Management. Colin, great to see you.
Likewise, good to see you, Andy.
It seems to be happening all over, interest rate reductions, and often central banks do that when they're worried about the economy.
Absolutely. It's something we all need. It's important for us all to remember is that when central banks are cutting rates, that initially it was couched as, well, we had raised rates to fight inflation, and now that inflation's coming back down, they can start to cut rates, which they did. And so that was fine. We started over the summer seeing these quarter percentage point rate cuts, but now we're starting to see acceleration. We've had two 50 basis point cuts in a row from the Bank of Canada. We had a surprise one from the Swiss this morning. Everyone thought they would go a quarter point. They went a half. Their benchmark rate was only 1% to begin with, so they went from 1% to 0.5%. That in and of itself is a big drop. So that's usually indicative when you see central banks starting to accelerate rate cuts. It's not a sign of confidence. It's not a sign of they've defeated inflation. It's a sign that they're starting to get more worried about their economies.
The U.S. Fed, there's a widespread expectation they are going to bring down borrowing costs next week. Of course, nothing is certain.
And that's true. And it's interesting because we look at what the central bankers have to say to themselves versus what the market has to say. And the way we look at what the market has to say is what they call treasury yields, or traded, I call them traded interest rates. And over the last few months, the 10-year treasury note yield in the States, which is the one most people keep an eye on, has been quietly climbing. And that suggests that people have been thinking for a number of months now that the U.S. economy has held up fairly well, especially relative to a lot of other countries, but that means that the Fed may not, the expectations are that the Fed may not cut as aggressively as people had previously thought, or certainly not as aggressively as we're seeing from other central banks.
Couple of stocks in the spotlight today. Oh, let's actually start off with gold, Colin. Are you suggesting to clients that they increase their bullion exposure right now?
Gold has done extremely well over the last year. But the last month has been a little bit tough. It had a good run through the summer into the early fall. It's now kind of consolidating. Gold is more or less in a bit of a holding pattern right now. So it's done well. It has interestingly, when we had that burst of enthusiasm following the U.S. election, we saw stocks in Bitcoin rally, and we saw gold kind of come off a little bit, have a correction it was kind of due for. But since then, it's refound its footing. Even today, down 1%. It's still trading near $2,600 an ounce. It's not that far off all-time highs, considering where it started the year. So it's actually been very well supported. And anytime we see any kind of a geopolitical flare-up, gold seems to catch a bid.
Yeah, gold even north of 2,700 today, depending, of course, if you're looking at which future and spot price, etc. Empire Company has been relatively out of favor among the grocery stocks. People concerned it doesn't have such a big source of profit from drugstores, for example. But the share's up today.
It's had a great move, and of course it's interesting because Empire is a little less, it doesn't trade as much as some of the other grocers. So when it does tend to move, its move can be magnified if a lot of people come into the stock at the same time. And we're seeing that today. We've got Empire's up 7.3%, Loblaw's up 1.3%, and Metro's actually down 0.1%. So we're definitely seeing within the grocers some rotation within the group, and with good reason. Empire beat on earnings, and they actually had positive same-store sales as well of about 1.5% same-store sales growth. So it was a pretty good number from them.
Finally, just give us an investing idea as we move to the end of the year. I was going to say the end of the road, but the end of the year. Traditionally, a decent time for stocks.
Absolutely. The November and December are historically very positive months for stocks. Now, September and October are often weak, so we've seen that, and they were positive this year. So there's a bit of a question of, did some of this year's Santa Claus rally get pulled forward into November? And it doesn't mean that we might have a correction, but we may not necessarily have as strong a December as we have in the past. We'll see how things go, but November was unusually strong. That was really driven by the reaction to the presidential election, and so now we'll see what happens. Are people still in the mood to continue buying, or are markets due to pause through the end of the year? No, and then we'll move into January, which also has historically we're still in this positive time of the year for stocks that usually runs through to about March or April, depending on the year. And of course, in January, we get another round of earnings reports. We'll get the presidential inauguration, and what starts to, you start going from anticipation to reality. And then what does that mean? So there's still a lot going on. There's a lot going on in various places around the world, and certainly no shortage of things that could happen between over the next couple of months.